my vlog. Welcome back. We are going to be reading chapter 6, same book, charting and patterns. Yeah. That's the intro. Get comfy here. Okay. Charting and patterns. Suppose you are asked to summarize demographics data consisting of millions of individual data points across a large geographical area. Of course, showing a giant spreadsheet on a projector won't be much use to an audience, since they are not capable of discerning any trades just by looking at numbers. A better option might be to create a pie chart or line charts in order to visualize the data and make it more palatable for the audience. By doing so, the audience will be able to instantly understand the key points before digging deeper. Charts are the single most important resource for many day traders because they provide these types of high-level insights into the market psychology. At a glance, they can help evaluate whether a security is trending higher or lower, whether investors are confident or nervous, and what levels are being watched most closely. Technical analysis believe that prices and charts reflect all publicly available information at a given time, which makes them one of the few resources that are truly necessary in order to make trading decisions. Day traders use charts to determine whether they should buy or sell, identify ideal entry and exit points for their positions, and ultimately improve the odds of placing a successful trade. Since they are focused on intraday price movements, the insights that charts provide are far more valuable than fundamental analysis-related insights that may take months or years to be reflected in an asset's price. Those proficient in chart analysis can pinpoint when an asset's price is about to break out, break down, or experience sideways trading. There are many different types of charts that reflect price patterns in different ways, making it possible to see them in different light. For instance, a standard bar chart discussed below shows the open, high, low, and closing price of a security over a period of time. While point and figure charts ignore time and focus only on trend changes, day traders can also examine these same types of charts across different time frames to gain a broader context. For example, a stock that's trending higher in a 1-minute chart may be doing so in the context of a steep decline in the 1-year chart, which means that a breakout may not be as durable. Charts can be analyzed and extended in many different ways by looking at price patterns. Day traders can identify potential opportunities in the form of support or resistance levels. Technical indicators can be overlaid on charts to provide visual insights into statistical analysis performed on prices over time too. For instance, a moving average can be overlaid on a chart showing the current average of the past 50 days worth of prices. These levels may act as support or resistance levels of their own if the market heavily watches them. The study of charts constitutes a significant portion of technical analysis, which makes them extremely important for day traders to understand. By reading charts every day, traders can become proficient in using them to identify promising opportunities and enhance their chances of making successful trades. Time frames. The stereotypical day trader sits in front of 4 or 5 monitors, with each of them showing actively moving charts and data feeds. While the need for many monitors is somewhat of a myth, many day traders do utilize a lot of different charts for the same stock or asset in order to gain greater perspective into the price action. This perspective comes from looking at different time frames for the same stock. Much like a traveler can zoom out on a map for greater perspective of where they are within a city or a country. For instance, an intraday 1-minute chart may show that a stock has been heading higher over the past hour or two. A day trader who based his decision solely on this chart might be tempted to buy the stock. But after zooming out to the 52-week 1-day chart, the trader may find that the same stock is in the midst of a significant downturn. These new revelations might suggest that the stock is undergoing a dead cat bounce and may be headed lower soon, which could lead to the trader short selling the stock, the exact opposite conclusion. Day traders may also use multiple time frames to establish many different levels of support and resistance. For example, a long-term chart may show a significant resistance level from a prior high that doesn't necessarily appear on a short-term chart. These levels are important since longer-term support and resistance tends to be much stronger than shorter-term support and resistance, given that they have been touched more frequently. Charts consist of various ticks, with each tick representing a given unit of time, and most day traders like to look at multiple time frames when making decisions. For instance, an intraday 1-minute chart shows up to the second price movements that are integral to day trading. But a 1-year chart with each tick representing 1 day shows a better longer-term overall picture. The benefit of the big picture is that day traders can ensure they are trading with the trend, and they may be able to better identify support and resistance levels. Most day traders prefer to have at least 2 charts, with one showing 1-minute data on an intraday chart and one longer-term chart that may be 1 day or 1 hour ticks over the course of a year. Of course, the exact time frames used will depend on the situation. Bar charts. Bar charts are the most popular type of chart used by both long-term investors and short-term traders. Using high, low, and closing price data, the standard bar chart consists of a vertical line representing the distance between the low and high for the day, with a short horizontal line showing the closing price. Bar charts enable traders to quickly determine whether the price closed near its high or low for the period, which can be an indicator of the market's confidence and help predict where prices may be headed in the future. So-called OHLC bar charts are a popular variant of the standard bar chart that show both the opening and closing prices rather than just the closing price. In these charts, there's a small horizontal line to the left of the vertical lines showing the opening price and a small horizontal line to the right of the vertical line showing the closing price. The benefit of showing the opening price is that day traders can get a much clearer idea of whether the stock moved higher or lower and whether it's closed and where it closed relative to the closing price. This chart is wasn't even worth them putting it in the book, but this is essentially what we're looking at here. All right. A key benefit of using bar charts is the ability to show a lot of data in a limited amount of space. Unlike candlestick charts, bar charts do not appear cluttered when a large number of data points are shown on the same chart and scrunched together. And unlike line charts that only plot closing prices, the bar charts provide a glimpse into price volatility by showing the difference between the high and low for each period. These dynamics make the bar chart an excellent choice when looking to fit the greatest number of ticks into a given time frame. The corollary is that the bar charts do 2 things only half as good as other alternatives. When traders are looking for detailed insights, candlestick charts provide a much clearer picture of what happened during the period. And when looking for clear-cut trends, line charts provide a smooth representation of where prices are headed. Bar charts compromise in both of these areas to provide a middle ground for day traders, which can be useful in some situations, but may be a hindrance in others. Okay. What else? Candlestick charts. Candlestick charts have become extremely popular since their introduction in Japan over 300 years ago. Like bar charts, candlestick charts use open, high, low, and close data to create insightful visualizations to help day traders better evaluate a stock. The key difference between a candlestick chart and a bar chart is the way each tick is represented. Whereas bar charts are simply vertical and horizontal lines, candlestick charts consist of candles that have a thick rectangular body and protruding vertical lines, shadows, or tails. The body of a candle represents the difference between the opening and closing price with a different color, depending on whether the closing price was above or below the opening price. As with bar charts, the vertical lines represent the period's trading range by covering the distance between the high and low. Technical analysis pay closest attention to the body of a candle, since its shape and pattern can tell an important story. For example, a small body and a short tail produce a candle that looks a lot like a plus sign. These candles are known as doji SARS and indicate indecision in the market, which suggests a potential reversal in the price trend. Multiple candles may also form patterns that yield useful insights. For instance, a large candle body that completely covers or engulfs the following candle is known as an engulfing and also indicates a potential reversal. Since the power is shifting between bulls and bears, some important candlestick chart patterns to know are, okay, I think we're gonna end it right there. Yeah, because candlesticks can get kind of detailed. So let's stop here and yeah, I think that'll work. And then we'll go over other chart types, candlestick patterns, price scales, point and figure charts, well, just various charts, and then recap. Yeah, I think that makes sense. Okay, cool. Pausing right there. All right. Thanks for joining, and I will see you next time. That's that.